Good evening. Good evening. Bear with me just a second. I want to see if anyone is in Discord right now. Oh, there we go. Only had a couple of people, then all of a sudden there was a big surge. I'm still going to post the link just in case someone might be looking for it. Give me 1 second here. What are we on here? Today is Tuesday. All right, let's drop this in. Hi, Sandy. Hi, Perry. Hello. Good evening, everybody. Welcome, Larry. Good to see you. Good evening, Bob. Let's just drop this in Discord in case anyone's hanging out there and forgot. Trading Foundations starts now. Okay, exclamation point, of course. All right. Well, good evening. Happy Tuesday, everybody. Welcome out to the Market Watch Group. Trading Foundations 2.0 technical analysis, part one. Larry says, nice to be here wherever here is. Yeah, here is where the heart is. No, that's home. You're right. I'm not sure either. Good evening, Stephen. Good to see you, sir. Yeah, we've gotten a great response already to the first couple of sessions. Remember that we are condensing. If you went through the videos, if you went through the first time, we're really kind of hitting the same things, but we're going to do it faster, try to cover more ground quicker, give us more time for options. Sandy says, did I mention how spoiled we are? I hope. So yes, technical analysis part one. You know I am a technician. So we do have two parts to technical analysis, only one part for fundamentals. I put it out there because if you want to go look at fundamentals or funnymentals, as some people call them, I don't know why, you certainly have the ability to build that in. What is my concern with fundamentals versus technicals? Fundamentals can help evaluate, right? We can get a relative sense of a company's strength via valuation ratios or growth metrics. And we can say, well, how does that look compared to its peers? And okay, so what's that going to do for us? It'll help us to pick stronger things. And that is an objective of ours. I believe we have a good methodology for picking stronger things, and that is strength is liquidity, strength is trend. Right? If trend is moving up, then we have a sense that price is already reflecting higher demand than supply. That's the bottom line here. So fundamentals certainly can help evaluate quality, but very difficult to assess when. When do you get in? And that's why I believe technicals is the superior of the methodologies used to assess companies. And that's why we're here. So my name is Scott. I'll be your host, of course. Let's dive in. Disclaimers, as always. This is for education to illustrate concepts. We are not brokers. We are not advisors, etc., etc. What is our agenda? Intro to technical analysis. So we do, like everything else that we talk about in regards to trading, we want to come at this with a very specific mindset, a philosophy. What is our philosophy? And technical analysis is I'll tell you a secret right now. Price is king. That is technical analysis. Price is king or queen. I'm fluid with my monarchy metaphors. So it's the most important thing. Price reflects everything. If it's happened, we know it. If we know it, we've already built it into the price. That's the assumption. And then we look for momentum and we look for periods where we can have favorable reward to risk based on the projections that we have, etc. So that's what we're looking for, is to understand that. We want to talk about the benefits that we get from technical analysis. And then we're going to start getting directly into it, and I'll stop and pull up charts and make sure you understand. We all may have different chart platforms. I'm on Thinkorswim for my trade platform. I will use Thinkorswim for my charts. I will use Thinkorswim for my options analysis. Charts are charts. If you gave me a set of charts within a couple of minutes, I should be able to figure out some basic things, and those are the things that we're going to be talking about. So trend analysis. This is in order for me. Yeah. Trend is first. Then I start thinking about support and resistance. Those are my transition levels, buyers to sellers, sellers to buyers. In context of those movements, I look at candlesticks. And you'll notice I put candlesticks first, candlestick patterns second. Candlesticks in and of themselves are a price action indicator, meaning it's just, it is what it is. It's open, it's high, it's low, and close. That's price action. I can certainly start to gauge things like sentiment based on, do I have a long shadow that indicates it went up and then came back down? Or some people call them wicks. Do I have a long body, which means whoever started just kept going and going, buyers or sellers? That's good information. That's different than candlestick patterns. Pattern is when I put a name on it, a doji, a dark cloud cover, a piercing line, shooting star, engulfing, harami, right? All these different names that we have. When we start to put formations and patterns on it, then we turn it into more of an indicator. An indicator is a calculation. Indicators are things like your moving averages. That's an indicator. You calculate it. An oscillator, stochastics, MACD, RSI, anything like that, that just sort of shows momentum up and down. Keltner channels, Bollinger Bands, moving average envelopes, all of those. I mean, there's literally hundreds of indicators. And that's why they actually are going to be in part 2. But right here, we're just talking about this. The last thing we're going to talk about today, volume, and that is we're definitely going to be talking about conviction and how volume helps us to see when there is a shift in conviction. That's what we're going into. Okay, let me make sure I catch up on my chats. Need some clarification on prices, stock versus option. They seem to get combined or confused when I trying to share them. Okay. Perfect. Larry, ask questions as they come up. We did go, there is in the content library, there are 8 options sessions. There are a couple of intro to options sessions here and there that if you're just kind of like making sense of the beginning concepts, we have a couple of intro to options videos that I think you'll find extremely helpful. And then we have, we get into the complexities as you start to make combinations and spreads, etc. So yeah, hopefully that will be useful. Thinkorswim, I love Thinkorswim. I've traded on that platform for, it's getting close to 20 years. I actually worked for Thinkorswim when they were Thinkorswim, publicly traded company before Ameritrade bought them, and now before Schwab. So, and hello, Elizabeth. It's great to see you. It's nice to have you. Such great energy today. Intro to technical analysis. What are we doing? This is our methodology that we use to evaluate financial markets, both the markets themselves and the individual components, whether we're looking at sector ETFs to gauge the strength of a sector or individual stocks to gauge that strength. But essentially what we're doing with technical analysis is we're studying historical price and volume data. We're incorporating chart patterns and technical indicators, and we're trying to use that information to help us project future price movements and trends. What's the argument against? I have no problem getting into that. If you talk to someone who's more fundamental, they're like, oh, you're looking in the rearview mirror, they say, right? Oh, you're looking backwards. Well, yeah, because we are looking backwards to establish trend and to understand historical patterns of behavior. I will tell you this, human nature does not change. I can give you a quote from a book. Sandy just picked it up the other day. Reminiscences of a Stock Operator is a fictionalized biography of a trader by the name of Jesse Livermore. Phenomenal trader. Absolutely phenomenal. And there are some psychology quotes in there that talk about the nature of man, quote unquote, man, traders, humans, and in how they succumb to emotions, fear, and hope and greed, and how our natural tendencies work against us as traders. 100 years ago, same thing that won the Nobel Prize. 20 years ago, same things that are absolutely true today. And that's what helps to validate technical analysis, right? Yes. Is there more quant trading, right? Mathematical trading where we have these AI models and things like that? Yeah, that's absolutely there. Go look at the patterns. They still look the same. There's still humans building those AI models. And so certainly it may change the dynamic, but if we're studying price, then we have the ability to adapt to whatever the environment gives us. Historical price and volume data are essential components. We watch charts. That's essentially it. It's not uncommon for us to be able to very precisely pinpoint transitions in markets. Why? Because we see specific patterns of behavior. And within those patterns of behavior, we see specific volume patterns where we see the buyers or the sellers taking control. We see one overcome the other. It's like a tug of war, right? That's what it is. It allows us to make informed forecasts about where prices may move next based on past behavior. We don't rely on any one thing, right? When we look at, for example, right now, we are under what I would call hedge alert, right? We're under hedge alert, meaning that right now there is a possible escalation occurring in the VIX that will trigger an automatic hedge for me, right? It will trigger an automatic hedge where I basically just go buy some puts on the SPY. Maybe they work out, maybe not. I'm not sure. It'll be protective. I do have bullish trades. I would imagine many of you have bullish trades. They were fantastic yesterday. Didn't look so good this morning, looked a lot better by the afternoon. And now we find ourselves still thinking, okay, is this going to continue? Technical analysis is what helps us to evaluate, is it going to continue? Well, we look at patterns and we say, you know what? My stochastics is still moving higher. My Heikin Ashi candles are still showing positive momentum. I'm going to give it another day. If those signals change and a pattern triggers something the other way where we say, you know what? When that Heikin Ashi turns red, most of the time following that, it retraces. So that's when I'm going to get out. It's not all the time. It's never going to be a crystal ball. What we're living with is most of the time. It's a pattern more often than not. That's what we're relying on. Technical analysis holds significance in trading decision making because it provides us the tools to assess sentiment. We do that on a weekly basis to identify entry and exit points. Where do we see supply shifting to demand, demand shifting to supply? Buyers and sellers. That's all we care about, buyers and sellers. And manage risk by making data-driven decisions. If we find what we believe is a support level, what are we going to do with that? I'm going to put my stop loss below support. As long as support holds, I'm going to be okay. If I'm buying options, I'm going to be less okay, because if it sits at support for 5 days, 6 days, 7 days, I'm starting to lose money because of time decay. So that provides a different dimension, but that's not part of technical analysis. Technical analysis is the part that says, hey, you know what? Yes, the buyers have failed to move higher, but the sellers haven't done anything yet. So if I was in the stock, I might give it a little more time. With the option, I'm going to start to get a little impatient. So you can see that how you trade will sometimes have an impact on our decision making, but the underlying fundamental decisions we make are going to be based on technical analysis. Let's get into that. Again, this is a little repetitive, I think. I got rid of one of my repetitive slides. I think I left one. I'm going to go through this quickly. Entries and exits. That's a core benefit. That's what we have to come up with. Entries, exits, and not just that, but also stops and targets, right? If I'm saying, hey, I'm getting into a stock, how far do I think it's going to go? I'm not going to just make up a random number. What am I going to do? I'm going to look backwards at the last 2 times that stock made a move. And I'm going to say, oh, it went from 41 to 47, 6 points. Before that, it went from 37 to 43, 6 points. What am I looking for this time? Not 12, not 10. I'm going to look for 6 again. And when I get my 6, I'm done. Some people may at that point put like, sell most, put a trail stop on. Okay. If you want to see if it goes a little further, great. For me, one, it's done what I've had, because if I'm going to get 6, ideally, I'm only going to risk 2. So now it's not necessarily that I'm like, oh, I'm so convinced I'm going to be right on this trade. I'm going to look at it and say, I have the ability to risk 2 to make 6 with what I believe to be better than 50-50 probability. Even at 50-50 probability, if you're getting 3-1 on your money with 50-50 probability, bet every time you have that scenario in front of you, right? You take that trade every time it's in front of you. Why? Because that's a positive expectancy. Even if you're right half the time, even if you end up only being right 40% of the time, 40% of the time you make 6, you're up 24. 60% of the time you lose 2, you're down 12. After 10 trades, you're up 12. That's a positive expectancy right there, right? That's a 60% expectancy for risk on your reward. How many points would you consider a reversal? For a true reversal, I have to see a break of support followed by a lower low, followed by a lower high, or vice versa. So I need 3 events to occur for a full reversal, right? That's kind of what, when you see a trade get into what I call a consolidation mode, you remember what I'm waiting for. I draw that line of consolidation that just sort of maps its downward slope. The first thing I'm waiting for is, let me just draw this actually. Oh, somebody put a question in the Q&A, and I get that makes sense, but I don't see that right off the bat. Let me get to that. So if something is falling down like this and I draw this line of consolidation, point number 1 is right here. It's got to break out of the consolidation. Number 2, I want it to get at or even above that previous high. It can't fail. And then number 3, that's the reversal completion right there. That's the lower or the higher low. That's when the trade opens up for me, when we're coming down and I believe that the reversal is completed. All right, let's get into this. I'm gonna have to start speeding up just a little bit, but I am answering questions as we go. What does that mean? It means we may not have a lot of time at the end for question and answer. So if you have one, throw it at me right now. Okay. Trend analysis. Trend analysis is the first thing that I'm looking at. What's the question here? Who's in control? Buyers or sellers, right? Who's in control? That's the question we're trying to answer when we analyze trend. Now, trend can be looked at in any number of time frames. I can find a trend on a 5-minute chart. I can find a trend on a 30-minute chart. I can find a trend on a 2-hour, daily, weekly, monthly. We want to make sure we understand what trends are we looking for. So in our market posture, we look at the trend of the 3-year weekly. Why? I don't trade that trend. I want to understand, because that's representative of institutional money, right? Institutions don't look at daily charts or intraday charts. They don't care. They can't move in that time frame. They look at weekly charts because they're much slower and steadier. That's the Titanic. It takes a while to turn it. I want to see that because I want to see what direction are they going overall. Right now, we have a great trend. It's coming down a little bit, right? We've seen a little bit of a pullback. We'll see if that continues or if we are able to continue moving higher. But that's all I'm caring about, is that what direction, generally speaking. So a market trend represents the general direction over a specific period, with different trend types, including uptrends, where we are now in both the long and the shorter time frames, downtrends, or sideways trends. Some people will sometimes call that trendless. There is no trend. Trend lines help in identifying visual trends by connecting significant price highs or lows. What are we thinking about there? Peaks and troughs. Now, peaks and troughs are important to us because those are transitions from buyers to sellers and sellers to buyers. So, of course, peaks and troughs are going to help us to identify support and resistance levels. That's what we're talking about next. They help us visualize and provide clear graphical representation of the trend's overall direction. Trend analysis is vital for understanding market direction, as it enables us to gauge prevailing sentiment, anticipate future price movement. We believe that stocks adhere and behave the laws of physics. One of the laws of physics we know is things in motion tend to stay in motion. So what we're actually trying to do is identify the path of least resistance. It's easier for them to move the way they're going. If it's going to reverse, it typically takes large increases in volume, a surge in sentiment, right? Okay. So that's what we're doing when we're looking at trend analysis. Let me take one pause, and I'm just going to kind of show you what we're looking at here. I'm just going to be pulling up charts. So whenever I come in, now this is SPY, but whatever stock we're looking at, what are we going to be thinking about? What trend is it? Now, when we look at the weekly chart, we're looking to find highs and lows. Now you can see there are a couple of times over here where it got a little above my line, and a couple of times here it got a little below. Yeah, remember that technical analysis, there's definitely an art to the science. I'm not trying to be rigid here. I'm trying to create a set of lines where I can see what is the overwhelming direction that this market is moving. My trend starts back in September of 2022. And now it's January of 2024. So this is going on about 18 months in this. And there's only 2 points here and about 3 points here. So about 5 weeks where it was a little bit outside of the trend that I've drawn. I consider that to be a very concise drawing of the trend. So in this case, what do I believe about the trend of the market, especially from an institutional standpoint? Bullish. It's bullish. And it has been for quite some time. Again, if you think back to that question about the reversal, let me draw quickly where on this chart we saw, why can't I get my lines? There we go. Yeah, so I had this consolidation coming down, and you can see it actually made the break and then gave us a higher low right there. Didn't go very far, came down, gave us the same low. Well, I'm okay with the same low as long as it doesn't break. And then from there, you can see we had our reversal. We went up, we came down, we've gone up. Are we going to come down? Maybe we could go sideways and then start to, because trends can accelerate and decelerate. Right? A trend, if this breaks to the upside, I might think that this is going to start to go like this and find a little bit steeper path. And we're going to score that more bullish on our analysis. And we're going to trade more aggressively because we see a stronger market. It all connects. Okay, that's trend analysis. And again, I could come all the way down here and say, oh, what are my trends? A little bit sideways right now on the intraday. But you can see we definitely opened low and regained quite a bit. Okay, what's next on our list? Support and resistance. You hear this a lot. I remember when I first got into technical analysis, just there seemed to be so much ambiguity around support and resistance. Oh, it could be here or here. Ironically, when I used to teach a boot camp style class a number of years ago, we'd put a chart up on the board. We'd say, okay, everybody write down, where do you see support and where do you see resistance? And then they'd write it down and pass it up. And we'd write it down on the board. And we'd have 20 people and 16 support levels and 16 resistance. I mean, they were very close, of course. One of the things we said, well, remember that support and resistance is a zone, not necessarily a point. We put a number on it, support's here, but really we have to give it a little bit of leeway, a little bit of cushion. Excuse me. Still a little bit of that cold left. Support levels represent price where demand is strong, preventing it from falling further. It's the floor. Support is the floor. What are you standing on? While resistance levels are prices where selling pressure increases, preventing the asset from rising higher. Resistance. The ceiling is providing resistance from getting to the next floor. Support and resistance, floors and ceilings. Support and resistance levels are highly significant in technical analysis because they indicate price levels where sentiment can and is likely to shift, potentially leading to trend reversals or continuation bounces. right? Is it bouncing? That's what we've been seeing here most recently, is trades that found support started to bounce. And the question is now, are they going to continue to bounce? Support levels can act as a potential buying decision point for traders offering favorable entry, while resistance can be seen as selling points where you either take profits, scale out, or if you're bearish, it's vice versa. You enter at resistance. So right off the bat, hopefully you can start to see through just these two technical analysis methodologies how trading rules start to develop. What would my trading rules be? Well, I'd first have to assess the market. If I'm in a bullish market, what am I looking for? I'm looking for bullish trends. I want to buy where the buyers are already in control. Where do I want to buy? At support or at resistance? Well, support is where the buyers start to come back in. Resistance is where the buyers have done their thing for 5, 6, 7 days already, and they're starting to run out of steam. So I want to find uptrending stocks, and I want to buy them when they're at or near support. So find a bull market, buy the dips. I've heard that somewhere. That's the thought process here. But we can't do that without understanding these concepts. If we don't understand how to evaluate the strength of a trend, if we can't identify support and resistance levels, it's going to make it a lot harder, right? Methods for identifying support and resistance levels include historical price data to see where prices have previously reversed or stalled, sometimes referred to as swing high, swing lows. Remember, the two concepts that I put on support and resistance are recency and frequency. Now, support doesn't always have to be a horizontal line. It can be a diagonal line, right? And in an uptrend, we would expect somewhat of a diagonal. I'm going to be aware of previous horizontal support levels and resistance levels where I might say, oh, this old high is where maybe we're going to find a new low, or vice versa. That gives us an ability to extend these levels and use them in our forecasting. But if we see that it's hit a certain point 2 times, 3 times, well, then yeah, expect a 4th time until proven otherwise. That's what I'm expecting. That's where I believe the probability lies. Drawing trend lines is essential for identifying these levels, as they can connect multiple support or resistance points, helping us to recognize the strength of trends and make more informed decisions. Let's just pop into a chart for just a minute and take a quick gander at what I mean there. So right now, I definitely have, whoops, where are we? A previous resistance right here. Now, am I thinking, oh, that's so strong, when it gets there, it's going to run out of steam? Is it strong? How many times has it touched it? Once. Just once. Right? I might start to try to draw a diagonal line where I say, okay, can I connect some dots through here? Maybe something like this, where I say I got a touch here and a touch here and a touch here and a touch here. And so now I might think, well, that's a much better target up here. Yeah, of course we'd like that more lucrative target. So how would I plan for that in a trade? Well, if I was doing a trade, I might look for it to get up here to target number 2. But at target number 1, I might decide I'm going to sell. If I have 5 contracts, maybe I sell 2 contracts or 1 contract, and I lock in a gain. Is it a huge gain? No, it's not. It's a pretty good gain. What am I doing though? I'm taking risk out of the trade. I'm locking in some profit, making it easier to manage what's left and give me a better chance of riding it up here without losing conviction. I'll tell you right now that scaling methodologies was one of the absolute best techniques that I developed to get better at cutting losses short and letting winners run. Trying to be like, oh, if it's going to get to the target, I want the whole thing. Do you? That's great, buddy. That was me the first couple of years I traded. I want it all. Give me it all. Now let's be a little bit more flexible, a little bit more reasonable about it, and have a willingness to replace what would be regret with gratitude, right? When you hold on to everything and the whole trade falls, you're thinking, I should have done something different. Whereas if I sell a piece of this and then it turns around, well, then maybe I can break even on the part that went wrong and I already locked in a gain and I walk away from a trade that failed with a small profit. How are we going to accomplish these things? I've got to be able to find these levels where I can say, yep, sell a little bit here. If I get within 20% of that target, I'm going to start trailing my stop much tighter. The closer it gets, the less I'm willing to give back. These types of methodologies make a huge, huge difference. Does this look a bit sideways? In the short term, I would say yes. Why? Because we do have 2 points. Whoops, I can't draw the line straight right now. Let me try a little better. Oh, that's not better at all. Holy crap. I'm struggling to draw lines today. Let me pick a straight line instead. Yeah, right through here, you can see we have a touch. We have a touch. Now on top, however, I've only got one touch. Have I been drinking? I only wish. I've got one touch, but not a second one. Now, if it gets up here and it touches this and this starts to fall, yeah, our market posture will have to take a quick and abrupt shift, right? We would definitely be like, whoa, wait a second. That's not good. We'll see what happens this week. That's I definitely see that as a possibility, especially when I look at the VIX still setting up. So, okay. Let's keep going. What time is it? Oof, I got to hurry up. I'm going to take a little bit of your time. Yes, Larry, that's exactly right. You're averaging your risk down essentially. A little profit. Yep, you got it. Love it. Okay, where's my presentation? There it is. What's next after support and resistance? Let me get to candlesticks. I love candlesticks. I would recommend a book on candlesticks. There's a guy by the name of Bigelow. I can't remember his first name. I don't own the book, but I've had a few people tell me they like it. The book I have is Japanese Candlesticks Explained, Japanese Candlestick Charting Explained by Steve Neeson. He's widely credited as the guy who brought candlesticks over. Great guy, very good trader. But we just want to have the foundations. What are the candlestick constructions? Open, high, low, close. It's a very interesting thing because different charts will plot candles different ways. Let me show you a little bit of what I mean. Here you can see that red candles are filled in, white candles are these open bodies. Some people have candles that close these with green and they have red and green. Sometimes you'll notice this candle here is a white candle, even though today closed lower than yesterday. Why is it white? It's white because we closed higher than we opened. Some places would color this a red candle with a open body because it actually closed lower than the previous. There are some subtleties that you're like, that's weird. I wouldn't worry too much about those. The main thing we're looking for is, where did it open? Where did it close? That creates the body. Usually it's red when it's down. So red days are down days. Yeah. Then we have the shadows of the wicks. Those are the points that, how high did it get? How low did it get before the open and the close? You can see the last couple of days, we were a little higher at one point, but we closed pretty close. We almost got back everything from yesterday. That's how candlesticks work. Now, from there, so we have bodies and wicks and shadows, wicks or shadow. We look at the ranges. How big of a shadow? And what does that mean? What did the buyers or the sellers try to do but then fail? We look at the bodies. How big was the body? Do I have 3 big bodies in a row or 3 small bodies in a row? If it's three small bodies, whoever it is, buyers or sellers, they're not doing very much. And it's quick for us to visually see that. That's what's important. There it is. Thank you, Bob. I was wondering, I thought it was Steven, but then I'm like, wait, is it Steve Neeson and Steve Bigelow? Apparently it is. The Steve's No Candles. Profitable Candlestick Trading by Stephen Bigelow. Like I said, I've heard good things about it, but I don't own that, nor have I read it. So I'm not giving that a personal endorsement. Japanese Candles Explained, or Japanese Candlestick Charting Explained. It's a yellow book by Steve Neeson. I think it's a phenomenal book. I would absolutely recommend you put that in your library. But you can always go learn candles without a book. One of the things that I would recommend you do is just go out and Google top 10 candlestick patterns. And you're going to see it talks about dojis and engulfings and haramis and dark cloud covers and piercing lines. And it's the things that we tend to see a lot. There are 69 major candlestick formations, 69. One time when I was teaching and I was at an event, apparently somebody found a website with candlestick flashcards, and it was during lunch and before and after the meeting was starting, you'd see people in their seats and they're like quizzing each other on, oh, that's a doji, the implication. And I'm thinking, okay, like I love the dedication, but at the same time, you're memorizing 59 candle patterns. You're just not going to see enough to remember them, right? It's just not going to, it's not beneficial. Learn the concept, learn the implications, understand the candle and the construction, learn some of the patterns. That's what you're going to want to do to implement these into your daily trading. Excuse me. The significance of the candle pattern and shape lies in the fact that they convey different messages to us about the balance between buyers and sellers. That's what we're looking to understand. That's why understanding the construction of them and knowing what the open body means, the closed body means, and understanding the wicks or the shadows. I just threw this on here. Heikin Ashi candlesticks. It's a very different candle. It's a constructed candle. Remember that candles by nature are not constructed. They're plotted. You plot the open, you plot the high, you plot the close, you plot the low. Plotted. The Heikin Ashi candlesticks are constructed, meaning there's a calculation that incorporates the concept of averages, and that produces a visually different understanding. It's different in the implications. I think I'm going to try to talk about Heikin Ashi in a little bit more detail next time, but I just wanted to throw these in here because they are correlated. Let me actually show you for a second. I thought I was behind, but I'm actually in a pretty good place now. So I still will go long, but not that long. So let me back this to 6-month daily. Now these are standard candles, right? And then I can come in here to the style and I can change this to Heikin Ashi. And you can see like, oh, Google 10 major, top 10, right? The top 10, not any 10, the top 10 that, yeah, it's exactly what I want you to do. Or if you're not signed up, I highly recommend you go to OpenAI and sign up for even if it's a free subscription to ChatGPT. I would absolutely encourage you to incorporate generative AI into your trading. If you just had a question that you wanted to ask me and you instead posed it to ChatGPT, I'm going to show you right now. I'm diverging for just 1 second. Let me pull this up. I'm going to show you what you can do. I love ChatGPT. What are the 10 most common candlestick patterns in trading? I don't even have to have, what does ChatGPT tell me? Doji, hammer, shooting star, engulfing, morning star, evening star, hanging man, inverted hammer, 3 white. Oh, look at that. Bam, just like that. So that's helpful. I could have it tell me what is the difference between candlesticks and Heiken Ashi candles. It's like Google, only better. It like is more organized and cohesive in its answer. That's really all it is. So here you can see what it tells you. It tells you about the construction, tells you about the appearance, how it can help with trend identification. I mean, this is amazing, right? So if you ever have just generic questions, start here. Ask it for where you could find out more. Anyways, okay, let's get back. Candlesticks versus Heiken Ashi. Very subtle differences, but I want you to notice how smooth this looks. Nice and green, slows down, green, slows down, then a little bit of red and back to green. So now you can see we're in these green. What does that mean? We expect this to go. If this doesn't go, if this fails now before making a higher high, that's problematic. We will see that as problematic. We will adjust our trading to that being problematic, right? Right now, everything still looks fine, and I expect it to still be fine until it's not. The great thing about this is if I get 2 more good days, these candles keep marching up, and I can use these for moving stops. Move your stop up the whole time. Move your stop up, but it is different, right? So if you look at this, more red, more it's just a little choppier. That's what the Heiken Ashi does. Smooths it out a little bit. Okay. Candlestick patterns. We just talked about that. Top 10 common candlestick patterns such as doji, market indecision, hammer, potential reversal, engulfing, a strong shift in sentiment, shooting star. We just saw all those in the top 10. Visual formations formed by candlesticks. These patterns can indicate potential changes in sentiment by revealing shifts in the balance between buyers and sellers. That's what we're looking for. Anytime we're looking at charts, we're wondering, what is the trend? Where are the levels that indicate the strongest likelihood for a shift? And then when do we confirm that shift? So some of these candlestick patterns can be the exact confirmation we're looking for. When we believe we have a stock in a setup, they help us to start to find triggers. So remember that at the end of the day, technical analysis is leading us to a very specific part of our plan, and that is trading rules. We need to take our technical analysis and turn it into very specific trading rules that say, if I see this trend, this pullback with this volume and these candles, I think I have a setup. Great. What are you waiting for? A trigger. What does that look like? Well, it might be a combination of a stochastics turning and price action crossing a certain point, confirming that the price is moving the right way. It might be one or the other, depending on how strong the market is. We've talked about the difference between anticipatory signals versus confirmed signals. We get to decide. If it's confirmed, you're looking for 2 things. If you're willing to go anticipatory, you're looking for the first indication that it's starting to go the other way because you believe it's already in an established trade setup position. Bullish candlestick patterns, like hammers and engulfing, typically suggest upward price movement. Bullish sentiment, bearish, such as shooting stars and bearish engulfing, indicate price declines. Again, just looking to understand the shifts and the changes in sentiment, and then being able to try and project sustained periods of momentum. And those are what creates our trades. Okay, volume. What does volume give us? Volume is conviction. Volume is the total number of shares or contracts of an asset traded in a given period. It plays a pivotal role as it helps us understand, is that valid? Right? Is it suspect, where we say, oh, yeah, it broke out, but there's not much volume? Well, then that's not much of a breakout, right? When I'm looking for bounces off of support levels, I actually don't want volume. Volume is what you would expect for it to break through support. If I'm expecting it to bounce off of support, what do I want to see out of volume on the 3, 2, 1 candles as it approaches support levels? I want to see the volume declining. Volume declining means there's fewer sellers. Remember that volume combined with the daily movement. So if I say, oh, we're down 1% today, and I say, oh, what was the volume? The volume was 120% of average. I'd be like, oh yeah, that's not good. There's an increase in the amount of selling and they pushed it hard. If I say that the market's down 0.5% and it's on 80% of the volume it used to be, I might think, ooh, whatever's been going on looks like it's starting to slow down. And sellers, when they stop selling, open the door for buyers to start buying, and that becomes a support level, a trough. Volume reflects market activity and participation by showing how many participants are buying or selling during a specific time, indicating levels of enthusiasm. There's a close relationship between volume and price movements, as higher volume often accompanies significant price changes. So there you go. Larry, pleasure to have you. If you're going to learn more about Thinkorswim, always a good measure. Here you can see I put an indicator on my volume, a 20-day moving average on my volume chart. Why? Because I really only care about volume when it's above average. That's when I think, oh, look, that's significant. Now, you'll notice here, when it first started to sell, big volume, it wasn't much of a day. Next day, big volume, yeah, we dropped. The next day, it was still above average, but it was declining. And then all of a sudden, we get to this day here. Still going down a little more, but then what? But then the volume was average. So what's happening to the sellers? They're declining. And then all of a sudden, well, that's a inverted hammer, a potential for reversal. What's this? A doji. We zoom in. A doji, indecision. What kind of volume? Below average. And then the next day it turns. What was the volume? Less than average. Less than average. What does that mean? Does that mean, oh, there's not enough buyers? No. Remember what I said. I don't need volume when I have trend. I don't need it. It doesn't have to be above average. I can show you times when the market moved consistently for 3 straight months, never had above average volume. That just simply means there's no sellers to be seen, right? Okay. Summary, and then some questions. And I'm going to pull back up to my charts and show you a couple things. So if you want to bounce, you can bounce. If you want to stay and watch me just play with the charts for just a couple of minutes, I'm going to do that. Key components of technical analysis include, number one, in order, trend analysis. Who's in control? Support and resistance. Where do we see the important levels of shifting between buyers and sellers? Candlestick patterns. Are you comfortable looking at the day-to-day to understand what are the buyers doing? What are the sellers doing? What did they try to do but fail? What did they succeed to do, etc.? We want to understand candlestick patterns. Do you start putting together things like dojis and confirmations, hammers, engulfing, shooting stars and dark cloud covers, etc.? And are you incorporating volume? Do you understand where the conviction comes in? This provides us a holistic approach to market analysis, highlights the importance of including technical indicators, maybe a bit of fundamental analysis, incorporating market news, and have an overall comprehensive understanding of market dynamics. That's exactly what we do, right? On our market posturing, we look at economic calendar, we look at the news that's coming out and what the implications may be. We look at how the market tries to price things like interest rate movements in advance. The use of these tools in combination underscores the idea that by integrating various technical analysis elements, we can make more informed decisions, improve the overall quality of our market analysis. Lastly, technical analysis provides a powerful tool set to actually start building trades using data-driven decisions to build our trading rules. Okay, so at this point, questions are open, but I'm just going to pop in here. I'm just going to kind of show you, anytime you're working with charts, there's a few things that I want you to be able to do. Number one, change your time frame. So for me, it's up here, and I have some default set. So I can move from a 5-day, 5-minute chart. Now this is intraday. I can move to a less intraday. I could go 20 days, 1 hour, or I could even tighten that up a little bit and go 20-day, 2 hour. and see it from this perspective. My default is 6-month daily. I want to see where have we been, where are we going, and where are some of the core levels. Right now, if I look at the SPY, I don't know what the levels are above this. I would have to back this up even a little bit more and say, what do I have? Oh, well, look at this. I have this back here where we are kind of at our highest high. We might be looking at one great big cup and handle. And some people would say, is that the cup and that's the handle? No, this is still the cup. And it's the cup until we get here. And then if we get a little handle and can break out of this, this is a Bill O'Neill pattern. The assumption is that this distance will replicate itself over half this period of time. So essentially, we're looking for this to happen again if it breaks out. That'd be fantastic, right? That'd be looking for this thing to get up around 600 on the SPY. That'd be phenomenal if we saw that. How do I know this stuff? I don't know anything. I'm looking at previous patterns because there's been enough times that when this pattern completes itself, well, that's not until over here we might see that. I need you to be able to understand how to add indicators. I can do it here. So here, when I click on this, you can see I have all these studies. There is a lot of studies that I could add. I could add a FM demodulator. I don't know what that does. Actually, I don't even know if that's a study necessarily. It looks like it is. I could add a floating PL. I can add a 4% model. Klinger histogram. I mean, you name it. Just because you can doesn't mean you should. You'll notice I try to keep my charts pretty simple. I have one moving average, which is the 50. If it breaks the 50, I add the 100 and the 200. So if at any point we came down here and we broke through this, bing, immediately I would come in and I would be like, okay, I'm going to come in and add, I'm going to make it exponential. So I'm going to take a moving average exponential and I'm going to make one of them. And this is what else I want you to be able to do. Change. This is 9. I don't want 9. I want 100. And I don't want it to be green because my other one is green. So I'm going to make this one pink. And then I'm going to take this one. I'm going to go to the settings. I'm going to make this a 200. I don't want it to be green. I want it to be gold. And then I say, okay, and now I have these other two moving averages, right? I don't want them on there now. I only want if I break the 50, because if I break the 50, these are going to come into play. You'll notice back here, broke the 50, touched the 200, went back up. Then when we broke the second time, we got down here to this moving average, and you can just, I want to see where those levels are. Okay, I'm going to erase those. What else do I want you to be able to do? I want you to be able to zoom in and out. So if you notice here, let me get rid of my drawing. I can quickly just isolate this part of the chart and zoom in. Now that's what I see. I can come back out this way. I can zoom in with this plus, and I can just zoom in one click at a time. I can zoom back out. I can zoom into areas back here, and then I can advance the chart to see how things moved at a certain point. The more fluid you are with your charts and your ability to manipulate them, to set them up exactly the way you like, the more comfortable you're going to be looking around and gaining perspective to make decisions. What do I think of the MACD? I think it's fine. So it's kind of a hybrid, or that was the attempt. It's a moving average convergence divergence, which is looking at it functions similar to an oscillator. Let me bring one up. Let me back this up. Now, anytime you're like, hey, what about this? Best thing to do, validate it. Come in, look up MACD, MACD. I'm going to do a histogram with crossed over. It's a full. I'm going to add selected. When I add it, you'll notice it's a 12.26.9. I don't know why that was added there. Why is it adding it there? Oh, there we go. Sorry. Not the crossover. That gets added to price. Just the MACD histogram. Then I'm going to move it up just below stochastics, but by itself. And I'm going to change it from a 12.26.9 to 8.17.9. I'm speeding it up. Why? When it comes to technical analysis, speeding up and slowing down changes the signals. A 20-day moving average versus a 50-day moving average versus a 100-day versus a 200-day. 200 days the strongest signal, 20 days the fastest signal. What do you want? You know, it's like my contractor said, good, fast, cheap, pick two. That's a lot of fun to play around with in your mind, right? You're like, good, fast, cheap. If I want excuse me. Okay, so let's apply this. Now, you'll notice these are turning pretty similarly, right? Now, sometimes this one turns and this one didn't. Well, it did actually turn. They both turned at the same time. So I would say an 8.17.9 MACD and a 7.3 stochastics function very closely. Now, you'll notice that here we're looking for the green line to turn up. Here we're looking for the oscillator, the histogram. It goes from a light red to a dark red. Over here, it goes from a light green to a dark green when it drops or when it increases. I mean, this is valid. What I should be able to do, however, I should be able to say, where do I want to get in? Where are the points I would have liked to have gotten in? And I might say, I would have loved to have gotten in right around, I'm going to just draw some arrows here. I'd like to have gotten in right around here, right around here, right around here. And then I say, okay, what happened? Well, this one, it looked great. These both worked pretty well, right? These both worked pretty well right through here. This one, not really. They were both a little bit overbought. That was a tough one right there. You would have needed price to have helped you there. We talked about that as a group and said, hey, sometimes when things are overbought, it stays overbought for a while, and you'll notice that happened. Now, if I look at this over here, oh, that's great. This turned right there before that move. Right there before that move. Now, you'll notice, what do we have? We have this. We have this. We have this. Is this going to be one of those great moves? Well, we certainly hope so. Right? What are we thinking here? We're thinking, does this maybe make another one of what? One of these. One of these. One of these. Those are all very similar. If I said to you, I'm looking for a move up here, what would you say? You'd say, well, based on what, Scott? What do you mean? But if I tell you I'm looking for a move up here to about 490 and you say that, does that fit? Well, yeah, that fits. That's very similar to this move and very similar to this move and very similar to this move. That seems reasonable to me. That gives me a starting point, allows me to create some projections of profit target. And I say, hey, if my profit target's up here and my stop loss is down here, and I'm getting in somewhere in this area, I'm getting a pretty good reward to risk. I should have at least 2 or 3 up here and only 1 down here. And in that situation, it's not necessarily that I'm so convinced I'm going to be right. I feel like I followed the signals and I've got a good probability of success. But more than that is I have a favorable reward to risk environment. And I have a plan that if this thing moves a little higher, I'm going to take a piece of that trade and lock some gain in. And then I'm going to tighten my stop loss on what I still have. And I'm going to say, okay, let's manage this trade. So that's what I want you to be working on your charts. We're going to talk about some more technical analysis on Thursday. But for right now, do you have the ability to put a moving average on your volume? Can you add stochastics? And then if you say, you know what? Yeah, stochastics isn't bad, but I still like Excuse me, his MACD isn't bad, but I still like stochastics. Okay, I took it off. Now I just have stochastics. What else do I have on my chart? I have implied volatility. That is not a stock indicator. That is an options indicator. Not something we'll talk about for technical analysis. Definitely something we'll talk about for options analysis. Yeah. Okay. Now, any questions? You have your marching orders. Go get super comfortable with your charts. If you aren't feeling fluid, where I could come in and be like, okay, take me from a 5-minute day. I should create like a quiz for charts, right? To see, can you move from here to here quickly? Can you do this? Can you do this? Can you do this? I think I'm going to build that. Actually, I think I'm going to use ChatGPT to help me build that quiz. All right. Well, no questions are coming in. So I hope that makes sense. This is how we do it. When you watch me and we're looking at charts and we're talking about, is this a setup? What is a setup? I need an uptrend. I have one. Elizabeth says that'll be helpful. Awesome. Yeah, right. I was just thinking, hey, something that just sort of tests your proficiency and then gets you thinking, what do I need to get better at? What's a setup for me? Do I have a trend? Yes. The trend is intact. Check. Do I have a pullback? There was a pullback here. Check. Do I have confirmation with price turning and stochastics turning? Check. So we had a valid entry signal. Everything was in place. I would expect that we're in trades. I hope nobody lost their nerve and exited this morning. Right? By the time the opening range was done, this thing was already coming back. No problem. Tomorrow will be interesting. Real quickly, I'm going to go here because we're done. And if you stayed around, we may as well get this last piece in. But let's look at the VIX. Yeah, I mean, it actually was a pretty good VIX day, but we're not out of the woods. This is the level. So if all of a sudden tomorrow, like today, it's like, okay, yes, one more good bullish day tomorrow, and there's a very good chance we see this down here, and that resets the signal at or below. That resets the signal. However, boop, boop, what if I instead get a doji tomorrow? And then what if the next day I get this? And at the same time, this comes down and turns. That is a higher low, higher than this low. That makes me fearful of escalation. And remember, my fear of escalation is that it broadens and that this is going to shoot on up. If the VIX is good, well, that's the thing. That's the thing. The VIX is good in that we've stayed below 14, but the VIX is not great in the fact that it's setting up for a higher low. And a higher low, normally a higher low is great. A higher low on the VIX, because it's a contrary indicator. It's an inversely correlated indicator. A higher low is not good. So up on the SPY spread, hope it goes up tomorrow. Yeah, it should move right into that sweet spot if it does, right? So, okay, I will see everybody first thing in the morning. We're going to talk more about this. We're going to see where the market opens and where the VIX is. Yeah, look, I would rather we just have three more bullish days to finish the week and let all my bullish trades work out. But I've got to be ready if the other happens. So I'm going to be ready. Okay. Anything else? I think we hit it all. It's good to see everybody. I appreciate the extra time. I hope you have a wonderful night. I will see you in the morning. And as always, happy trading.